Welcome back to our channel, your go-to source for financial wisdom. In today's video, we're going to dive deep into a financial rule that's simple yet incredibly powerful. The rule of 72. This is a simple mathematical formula to understand how fast your investment would grow with time. Stick around because we're not only going to explain the rule of 72, but also provide you with 5 practical examples to help you grasp its full potential. Let's get started understanding the rule of 72. So what exactly is the rule of 72? Well, it's a quick and easy formula to estimate how long it will take for an investment to double. Given a fixed annual rate of return, you just take the number 72 and divide it by the annual interest rate. The result is the approximate number of years it will take for your money to double. Simple, isn't it? Now let's understand its applications with different examples. Example 1. Let's start with a practical scenario of a savings account. Imagine you have $10,000 sitting in a savings account with an annual interest rate of 3%. To find out how long it will take for your money to double, we apply the rule of 72. You divide 72 by 3, which equals 24. So it will take approximately 24 years for your $10,000 to become $20,000 in that savings account. Actual value is 23.45 years. It's worth noting that the rule of 72 provides a reasonably accurate estimate, coming very close to the actual value in this case. Example 2. Now, let's talk about the world of stock investments, but this time we'll explore how different interest rates impact the time it takes to double your money. First, conservative approach. Imagine you're aiming for a conservative approach with an annual return of 5%. Use the rule of 72. Take 72 and divide it by 5, and you'll see that it will take roughly 14.4 years for your initial investment to double with a 5% annual return. Second, moderate growth. On the other hand, if you prefer a moderate annual return of 8% on your investments, the rule of 72 reveals a different picture. Divide 72 by 8, which equals 9. This means your initial investment will double in approximately 9 years if you achieve a 8% annual return. Third, aggressive growth. Suppose you're willing to take on more risk for potentially higher rewards, targeting an annual return of 12% on your investments. Apply the rule of 72 by dividing 72 by 12, and you'll find that your money will double in approximately 6 years with a 12% annual return. These examples illustrate how different interest rates can impact the time it takes to double your money. Example 3. Here we will explore how the rule of 72 is applicable in the realm of real estate. Suppose you purchase a property valued at $200,000, and you anticipate a 6% annual increase in its value. Apply the rule of 72 by dividing 72 by 6, and you'll discover that it will take around 12 years for the property's value to double to $400,000. Actual value is 11.9 years. As you can observe, the rule of 72 provides a very close approximation to the actual value. Example 4, comparing inflation and retirement savings. Now, let's employ rule of 72 to see the impact of inflation on the money needed for retirement. Imagine you determine that you'll need $1 billion to retire comfortably in today's dollars. However, if you don't account for inflation, that $1 million won't stretch as far in the future due to rising costs. The rule of 72 can be a valuable tool here too, where you can use it to estimate how long it will take for your expenses to double due to inflation. For instance, if inflation averages 3%, you can divide 72 by 3 to find that it takes about 24 years for the cost of living to double. So in 24 years, you might need $2 million to maintain the same standard of living. Example 5. Let's switch gears and look at the flip side, credit card debt. Suppose you have a credit card with a hefty 20% annual interest rate. Applying the rule of 72, you divide 72 by 20, giving you 3.6. This means your credit card debt will double in just 3.6 years if left unchecked. As a stark reminder of the importance of paying off high interest debt as soon as possible. Additional tips and considerations. The rule of 72 is based on the assumption of annual compounding. If your investments compound more frequently, such as quarterly or monthly, the rule of 72 might not be as accurate. In such cases, you might need to adjust your calculation for a more precise estimate. Conclusion. So there you have it. The rule of 72 demystified with 5 practical examples. Whether you're saving, investing, or managing debt, This rule can help you make more informed financial decisions and understand the power of time and compounding. If you found this video helpful, please hit that like button, subscribe for more financial insights, and share it with your friends. Remember, mastering concepts like the rule of 72 can be a game changer for your financial future. Start applying it to your financial planning today. Thanks for joining us. And until next time, stay financially savvy.